Hi, everybody. Welcome to the show. Today, we're excited to have Lauren Wells, co founder and chief strategy officer at 7E Investment. Lauren is a seasoned real estate investor with over a decade of experience. I wanted to have Lauren on the show to talk about this alternative investing option because I feel like it's one that not a lot of people are aware of, but can be a nice wealth building strategy to add to your passive income portfolio. In a nutshell, it's basically like you becoming the bank. So, Lauren, welcome.
Thanks for having me. Excited to be here and talk about all things investing and mortgage notes and everything in between.
What exactly is mortgage note investing? Because most people, when I ask around in my circle, they don't really know much about. They may have heard the term, but they don't know exactly what it entails and what it is.
Yeah, so most people, you're right. You're absolutely right. Most people kind of give me a funny look when I tell them what I do. Essentially, I think most people are familiar with passive income, this idea of wanting income. Most of the time when they connect it with real estate, they think, oh, I want to own rental properties. The mortgage notes kind of takes a different approach. So instead of dealing with tenants, like you mentioned earlier, you're assuming the position of the bank. You're becoming the lender. So you're buying mortgages and you're essentially receiving payments from borrowers. And there's so many different facets within it. You can invest in non-performing mortgages where people aren't paying, and that's a whole different strategy than investing in mortgages where people are paying on time as expected. Think of it as you become the lien lord, you're not the landlord. Very similar, much less active, still active, but much less active than owning like a rental property and being the landlord.
How exactly do you take over these notes? And then you mentioned performing and non-performing. Like, what does that mean exactly?
Essentially, when I first started out, I got on a ton of brokers lists where they would be selling individual notes to investors who are looking to invest. And you go through, I learned a lot about what I needed to look for in a note, kind of did my due diligence on the asset and the borrower, because really the borrower is what you're like concerned about at that point. And the house and the value, obviously, but learning about the due diligence process and kind of how to bid on notes and what I was looking for from a yield perspective. I mentioned performing and non-performing, deciding, okay, do I want to invest for a lower yield in a performing note, which performing just means that the borrower is paying their mortgage every month on time as expected. There's more security in that. You know, you're getting a lower return. I would say you're looking at like a 10 to 12% return versus 15 plus, but it's consistent. You're not as active because they're just paying and you're getting paid. And then you have your non-performing assets, which is anyone who hasn't paid in 90 days or more. There is inherent risk in that because you need to figure out why they stopped paying. You need to make sure there's ample equity in the property because as the bank, as the lender, you're entitled to the property if they choose not to continue not to pay. A lot of people get into this thinking, oh, I'm going to go into non-performing and take back the property and then I'll have a rental property. If it were that easy, everyone would be doing it. But typically the easiest thing that I found that we found at 7E is to work with the borrower, because if you do your due diligence correctly, you're able to see that most borrowers don't just wake up one day and decide to stop paying their mortgage. Usually it's some sort of job loss, health, divorce, or life instance. And typically you can look at during your due diligence and see the prior lender's notes, and the borrower might have actually tried to reach out and got paying again. But banks and other lenders are notoriously just inflexible with their repayment terms, to the point where if I'm 20K behind on my mortgage because I lost my job and I go back to the bank and say, hey, I can start making my monthly again, I got a new job, they'll say, great, but we're going to apply that to your late fees and your past due. So there's really no way of this person, aside from coming up with like a 20K cash payment, to get back on track. They're always going to be considered non-performing, even if they're paying monthly. There's a lot that goes into it really on the front end in the due diligence, but it's something that I found and we found at 7E that's been able to provide us with income, mitigate risk really because we have the security of the asset behind it, and not as active as owning like a rental portfolio.
In a way, it sounds like maybe it's a little bit easier investing instead of having a rental and being a landlord, right? Because you're not having to worry about that other stuff.
Yeah. We're never really not getting calls about my roof is leaking or the toilet's not working. Yeah, no.
And none of that. Going back to the performing and non-performing, why would a bank get rid of the performing note that they're getting paid on time?
Think about it like this. About 2 years ago, we were seeing rates at like 3%, 2.9, and everyone was refinancing. And now, yes, banks have a lot of loans on their books at 3%. And yes, they may be paying, but they're losing money on those loans because interest rates are now 7%. For them, it's easy to sell it at a slight discount and recoup, go and write a new loan at 7% because they're going to make more money on that in the long term. That's kind of where investors come in and say, hey, I'll buy these performing assets at a slight discount because I can still get my yield based on the discount that I'm buying it for.
What is the due diligence process? Like, how do you know it's a good deal?
Some people are very specific on where they want to invest. So they'll say, I'm only going to do notes in California, or I'm only going to look at notes on Ohio, whatever that might be. We're pretty market agnostic in that, we invest all over the country. There are states we stay away from, like New York and New Jersey, because they're very hard to work with when it comes to like if you do need to foreclose. But really what you're looking for is, okay, what yield are you looking to get? So like on a performing asset, say you're targeting a 12% return or 12% yield, then okay, on a loan that's written at 6%, I need a 50% discount. Not only does the discount make sense to line up to get you your return, but also is the property value, is there enough equity in the property? You don't want to look at anything that might go if the market, which I know everyone's, kind of asking right now, what's going to happen with the real estate prices? We're worried that they're going to drop. Well, if that does happen, are you covered? You don't want to be underwater as a lender or as a borrower. And as a lender, you don't want that property to be worth less than the loan because it makes it easier for borrowers to not pay or walk away. And if you have to go to foreclosure and it is underwater, you're not going to get paid off the full balance of the loan. So it's really looking at the value of the property, states that you want to work in or don't want to work in, whether you're looking at a first position lien or a second position lien. A lot of people only want to do first. Seconds are cheaper and easier to get into, but there is more risk there because you're second to being paid to the first. There's kind of a few criteria and factors that I guess each individual would need to figure out before they decided to invest in mortgage notes. Do you want to do first? Do you want to do performing or non-performing? Do you have specific states? Are there like certain size loans you want to look at? Some people might say, I only want to look at loans that are $100,000 to $200,000, where other people might say, I want to look at loans that are $500,000 to $1 million. And those are very different loan types and borrowers. And then you can get into the due diligence once you've kind of written out your initial buy box, I guess.
So I'm assuming that there's a gigantic spreadsheet and you're doing underwriting as well, and calculations and a lot of numbers that go into that.
Yeah. So essentially, when we get what's called a tape, which is basically a glorified Excel spreadsheet of assets that a seller is looking to sell, it is a lot of reformatting the columns, seeing what is we like color code it. So it'd be like red if it's like does not fit our buy box in any way. Green is like, yes, let's look at this. And yellow is like, there's some underlying criteria we want to sure make sense before we move forward. And yeah, it's really, okay, like basically taking the columns, verifying the value, making sure it's like, if you're looking at first position liens, making sure it's first position lien, looking at title, having an attorney review the collateral. So unlike investing in a real rental property where this is the property, you're looking at the area, you're pulling comps, there's a lot more due diligence, I think, that goes in on the front end for mortgage notes because you have to look at the legal side of it as well. Is this collectible? Is the borrower the one on title? Is the borrower the one whose name is on title and on the mortgage? Sometimes that's not always the case. So there's a lot of due diligence that goes into it like actually committing to onboard the loan, which I don't think is the case with like most other passive income. It's like more active on the front end, less active on the back end, where I feel like it's the reverse for other aspects of passive investing.
I just want to go back because you mentioned high interest rates. How do you see that affecting the environment for a mortgage note investor?
Yeah, we like to say we're like interest rate agnostic because when we're bidding on assets, the interest rate is kind of baked into our overall bid. If we're looking for, I'll go back to kind of the example we always give is if we're looking for 12% return on a performing note and it's written at 9%, we'll need a 25% discount to make those numbers work. If it's written at 6%, we'll need a 50% discount to make those numbers work. It's kind of baked into our initial bid, and that's irrelevant of like where the interest rate market is. I think what it does do is it affects our supply demand. We don't necessarily track like, oh, interest rates are going up, but inflation, cost of goods, the job market, credit card default, we kind of track those as leading indicators of, okay, we're probably going to see a ton of mortgages go into default here shortly because people are losing their jobs. They're not able to keep up with the cost of living. Credit card debt is out of control. And typically mortgage defaults follow that. So interest rate agnostic, more so looking at like the overall picture of what's happening in the economy. That would maybe give us more inventory, which is only a good thing for us because then we get better pricing.
So when things aren't looking so good in the real estate business, it's kind of like opportunity time.
Yeah, yeah, it's a little bit inverse. Like during COVID, there wasn't a ton of inventory, but on the flip side, everyone was refinancing, so all of our loans were getting paid off because people who might have had their loan for, 15, 20 years were like, "Oh, wow, I can refinance into a 3% rate." And we were getting paid off like left and right. Regardless of the economic environment, there's a way to win in mortgage notes.
It sounds like a pretty good strategy, I think.
Feel like it's definitely not like super bright and shiny and something people talk about, but it's consistent, it's predictable, and it works once you know what you're doing.
Do you get other tax breaks or tax benefits?
No, so that's the one thing that we get asked a lot is like, "Oh, is there any sort of depreciation or anything?" And so no, there's not. There's nothing that you can like write off or write off as depreciation.
There's always a catch.
There's always a catch. Yeah. That's not yeah.
I'm sure there's other ways to offset taxes.
Yeah, for sure, for sure. Most of the people that work with us as investors are looking for more of that income, whether it to subsidize retirement or cost of living, or they're looking at it for their retirement accounts. They're using their retirement account, self-directed IRAs to invest. Definitely, it's a different subset of investors than the people who are looking for tax defer.
Ah, I see. Right. That makes sense. If you're using for those of you there where you can have a solo 401k or self-directed IRA, you can use that money to do investment. You have a checkbook IRA, basically. Invest. And yeah, that money goes back into your retirement account. It's all the tax benefits of a retirement account.
Yeah, exactly.
Okay, so I wanted to get into a little bit about your background. How did you get to become and be the co-founder of 70 Investment?
I actually, went to university, graduated, and worked in tech as a software salesperson for many years. But I played collegiate sports in college and started actually volunteering at a local high school water polo team. What I realized was that I didn't have kids at the time. I think I was maybe newly married. But I realized that all the parents that were at everything, games, practices, I don't know, everything that they were there. They were always showing up. They either owned their own business or they invested in real estate. I knew that I had parents who were very involved, who were always around. And again, they invested in real estate and own their own business. I don't know why it didn't dawn on me then, but seeing it as an adult, I realized that when I have kids, I want to be able to go to their soccer practices, volunteer in classes, be there and be involved. I started attending real estate, listening to podcasts, attending real estate investment networks and meetups and listening online to different thought leaders in the space. And I stumbled across mortgage notes. I probably reached out to 50 to 100 different people in the space and just picked their brain on how to get started, what's their strategy been, have they been successful? And then I started building my own portfolio one at a time, met my current business partner, Chris, who was speaking at a conference, and started helping him manage his portfolio. And then we launched some funds together. And then this most recent offering partnered together on. I will say it's still busy, but I do feel like I have more control over my time and I am able to kind of meet those goals and show up when my kids are having the jogathon or want to volunteer in class or picking them up from school, little things.
Good on you for recognizing that pretty early. It sounds like doing a lot of homework and asking around and doing a lot of networking on getting into changing your career path. I have a similar background. I came from tech and I saw those things. But after having kids and realizing, wow, I'm missing on some fun stuff at my kids' schools and I want to be there. I want to be that parent that's present. So yeah, I did that same thing, career switch to real estate and started my own business for the very same reason. Still busy. It's still like, you know, it's not like less work, but at least you own your own time and you have hide. Granted, it might be at 2 a.m. or 1 a.m. No, everyone's sleeping, but
Yeah. But you can do that in a tech job. Everyone's sleeping. But it's about the time ownership, I think.
owning
Yeah,
your time, right?
for sure. 100%.
That does lead me to a question, that the work-life balance question, because obviously you're a boss lady. That was 70 investments. doing a lot of things. And sometimes I hesitate about asking this question about how do you balance being a leader, managing your company while having two kids, almost three. Congrats. Because, like guys don't get this question, right? During your
Well, it's funny because I was going to say I have a very supportive husband who's super involved, probably equally, if not more involved with the kids. So I feel like that has been huge and allowed me to like pour into work when I need to. And it's not always super busy, but when it's busy, it is. And knowing that he's equally as involved is super helpful. I say balance changes from week to week, month to month. Some weeks or some months, I'd say I feel like I can work out, eat healthy, be there for the kids all the time, and business is cruising. These last 2 months have been insane. We launched a new offering, and it's definitely been more work focused. Other areas are usually that suffer more are like my working out. I'm like, there's not enough hours in a day. So I'm either have to get up super early or I'm doing it at night and I'm not a night working out person. So that doesn't happen. I don't know. I think for a long time I had a hard time balancing and being frustrated if everything wasn't super even. And now I just acknowledge that there's going to be very heavy work balance times versus family balance. And also, like you mentioned, we're having our third kid. So I'm also trying to make sure that I set up my team for success so I can take some time to actually unplug and be there and enjoy this new baby that we're bringing into the world with my family. And I think a lot of the prep for that comes now. So now is going to be more work heavy. So just kind of acknowledging that we're doing the best we can with the phase of life we're in. Parents today are just being pulled in so many different directions. Also, oh, you need to feed your kids this. There's this new study that shows that. And you're trying to stay on top of all that as well. So I just feel like having grace with yourself and doing the best you can.
One thing that's for sure in parenting is that change is constant. Once you figured out something,
Yeah.
it changes. Like, and then it's, yeah, you're got to figure something else out. And
Yeah, which I feel like makes you a better business owner because you're not phased by the constant change and of evolution of the business, which people struggle with. I mean, I'll give an example. My 7-year-old, we're cruising through first grade and it's been great. And then the last few weeks, getting out of the house in the morning, I'm like, what is going on? Why is this a struggle? Did you eat enough? Have you slept enough? I'm like analyzing all the things, but it's just he's got some big emotions. I got to pivot and like figure out how to help him through whatever he's feeling. And then I'm sure the second he's kind of back in a groove, my 4-year-old is going to find something that he's needs extra help with or Disney phase. So it helps. I feel like it helps in business though. It makes you
resilient. Resilient.
know whatever they want to call it.
Totally agree. I have a 7-year-old. I feel that phase. I don't know if it's just a phase, and I hope that's hopefully hopefully ends quick.
He's so sweet. And we were in such a groove and I was like, it was so fun. And now I'm like, I don't know if you're going to wake up happy or not. And I'm terrified. So we'll get through it. I think also when, you and I both live in California, I know we are so great. I'm grateful to live here. The weather is all the time pretty great, but winter still is winter for us in its own way. And I feel like we have a harder time in winter. We're having beautiful weather this week and I'm like, we can go outside, we can run around, we can go to the beach, we can do all these things. And it makes everything easier. So I'm just gonna chalk it up to like we had rain the last 2 weeks, and that's probably why he's
I did read in your bio you like to travel.
Yeah. Yeah. So something that before we had kids, my husband and I traveled a ton all over Europe, South America. We're trying to incorporate that into our kids' lives as well. It is definitely very different traveling with children. I think that was one of the big moments when I made that shift was my husband and I actually did this hike in Spain called the Camino de Santiago across Spain.
Wow, how long was that? That sounds like a big hike. I think I read.
It was 500 over 500 miles. So you just like,
Wow.
yeah.
How long did that take you?
It took us, I think, just 30 days.
Wow.
Yeah. Yeah. It was pre-kids again. So just us. I just remember being on that and meeting so many people who were in some sort of life transition in between jobs or retired. And I wondered at the time why we never saw people who were in their 30s. Now I know because they're at home with their children. It was either young people our age or people who this was their like retirement thing that they did. And I just remember that my husband was on sabbatical. I had left my corporate job at that point. I was thinking, do I get another corporate job to subsidize like what we're doing in real estate? after that trip, I remember being like, we could never have taken this time, 30 days, plus we spent the whole summer before with his family, just to like enjoy life if we were at corporate jobs and really stuck to this 9 to 5. You only have a certain amount of time off. And I know unlimited vacation is a thing now, but I still don't think people are going to take a month off.
No, I had that at my last corporate job, and that is a psychological the twist. You feel like you have unlimited time. That's what they tell you, but psychologically, you're like, no, no, no.
Not gonna take this because you feel like you're not there to use. It's weird. Yeah, it was a big pivot for us into not going back into corporate. And then my husband going into more of like a consulting role.
Yeah, I mean, the mindset there, that definitely has changed my trajectory as well because I love to travel as well. That has kind of shaped the things and reason why behind owning my own company as well, so that I can have some of that time freedom. Ultimately, people just to travel when I want, especially with my kids. So,
Yeah, for sure. For sure.
okay, so let's get back to talking about some more investing.
Okay. Yeah.
Why is investing in for passive income so important? Why is it so important to kind of look at all your options, alternative options for investing?
Yeah. I feel like the world of alternatives needs like a rebrand because alternatives, I feel like sounds scary and different.
Yeah, I think everyone automatically thinks like, oh, some crypto.
Yeah, or like
Yeah.
for risky. I definitely feel like someone needs to rebrand that. I don't have the energy or the time, but someone needs to rebrand alternatives.
What would it be called?
I don't even know, but not alternative just makes it sound risky and like
Some black bars, like,
yeah. One thing I realized was getting into this world, and especially being someone who now has their own fund, is that there are so many different ways to diversify your investments outside of stocks, bonds, and mutual funds. With people leaving or switching jobs, you could actually use that money to invest in alternatives to grow your net worth outside again of the stock market. All the things I wished I feel like they should have classes on in college that we don't learn about, or even high school, really, to teach kids about financial literacy in general. Stocks and bonds are one way, but you can also invest in real estate. You can invest in oil and gas. You can invest in clean energy. And one's going to give you income, one's going to give you tax advantages, one's going to give you tax credits. So I think there's so many different ways. And I think one way to I don't know if I would Google alternative investments, but because who knows what would come up. But
PT, chat,
the like, give me a list of alternative investment options outside the stock market. It kind of opens up your world so that right now we've seen the stock market tank the last few days. And I know people who are close to retirement are probably freaking out. We've been booming for the last several years. So to see their accounts take a hit is probably not great. But I think there's a lot of opportunity for people to diversify outside of the stock market if they're looking for ways to kind of hedge their bets where they don't feel like everything is tied up in how's the NASDAQ doing.
I mean, I think the key principle is diversifying, right? Don't put all your eggs in one basket. That is something that they, I think, teach in school, but we don't definitely get enough financial literacy in our school. For one, I didn't know about all this stuff. I didn't know about solo 401ks and being able to use my retirement money to invest until
Yeah.
way too old. Like I think till 40s. It was probably until a couple years ago. And I wish someone told me about it. I wish I knew earlier. That's part of the reason why I wanted to do this podcast, to bring awareness that there are other options available for you and for people to invest. You don't have to always just go to your big banks or Wells Fargo or Northwestern or typical financial advisors.
Yeah, and I'd say even a lot of financial advisors don't really play in the alternatives arena. I know there are some that do, but for the most part, they're still focused on the stock market and annuities and fixed income funds. I think the best way to honestly get started is if you have an old 401k from an employer, or if you've gotten laid off recently, or you have an IRA that you've opened, is making it self-directed. Opening a self-directed IRA with a custodian, funding that and allowing that to be your alternatives investment fund that you then can fund into different asset classes. It feels safer because you can't touch it anyway, especially if you're not close to retirement age. I think that's how we started. Is when I left my employer, that was another thing we did. We rolled it into a self-directed IRA, and they'll provide a lot of educational webinars on different alternatives. So even if you don't have an account with these custodians, maybe it's worth looking into. I think UDirect, IRA Club, Inspira Financial, there's tons of them that have education for people who are looking to invest outside of the stock market, because that's most of what their client base does. So I'd probably look into custodians and see what, webinars can I sign up for that they have on different alternatives.
I mean, it definitely opens up a whole new world of opportunities once you realize and you are a little bit older and you have worked for a good part of your life and you have a little nest egg. And then you realize, well, I could do more things with this. So I don't have to put it in the plan that they tell me, like, well, my target option plan of retiring in 2060 or whatever. There is more options out there. You could go and buy a house if you wanted to. The world is your oyster.
I've said that quite a few times in the last week.
What is then one investment tip you'd give to someone just starting out?
If you were younger with zero responsibilities like kids, mortgage, none of that, I would say open an IRA, fund it, experiment with that. I mean, you have so much time on your side. Even if you're using your IRA to invest in something like an index fund, you still have a lot of time compared to someone who's from 25 to 35 to 45 to 55. I'd say if you're in your 30s or do have responsibilities like kids and a mortgage, I would look at an old employer's, I'm assuming, making assumptions here, but I would take an old employer's 401k, I would roll it into a self-directed IRA, and I would start learning on different options that I had available to me. And I think at that point, you're looking for not too much high risk, whereas when you're younger, you can look at higher risk. I'd say I'd be looking for a mix of income and growth. If I was of retirement age or nearing it, I would probably look at just, especially right now, given the economic climate, I would probably be more conservative and I would look for more fixed income alternatives. So again, I wouldn't look in the stock market right now. I would be looking outside at alternatives that offer a fixed income, and knowing like what we've seen in the last 7 years has been out of the ordinary. So kind of like I think people right now, or a lot of investors I speak with, are having to reset expectations because they're getting burned on some funds that they've been a part of. And they're like, I shouldn't have chased that high yield. I should have just been like, I need consistent and steady income. So I think there's a lot of investor expectations which are being rewired right now to set people up for like, okay, what's realistic in the coming years? Because what's realistic in the last 7 is not happening right now anymore. And I think people are starting to realize that.
Could you talk a little bit about the fund? You mentioned you just have launched a fund.
Yeah, so we launched a income and profit share fund, which basically allows people to accredited investors. We have 2 funds. We have one that's open to accredited and non-accredited. That's been open for a while now. That one is great for people who are new to alternatives, because if you look into alts, the one thing you'll notice is most of them are, 1, limited to all accredited investors, and 2, they require a 25, 50K minimum, sometimes 100K minimum. Our Reg A fund is open to accredited, non-accredited. It has a 5K minimum. You can do cash, you can do IRA accounts. And then we have a new fund we launched only to accredited investors. Again, it's fixed income, but it also gives them a piece of the profits. There's something really for everyone. Both have been pretty well received. I think the first one, the original offering, really was started because of my former self being like, there's no options for non-accredited investors. And I don't want to put 50K into my first alternative because that seems like a big commit. Once I learn the ropes, that doesn't. But in the beginning, it's a lot. You're like, I don't know what I'm doing. I feel like it's something that started out as a passion project and it's kind of grown. And it's been really cool to see it take off.
What kind of returns are people getting from your fund?
So our one fund offers anywhere from 8 to 10% annually, and we pay monthly distributions. So it really is like people are seeing it as this like monthly income. And then our newer fund pays 9 to 11%, again, paid as monthly dividends. And then there's the kicker at the end of the term. So both of our funds are either 4 or 5 years.
4 or 5 years? Okay.
Yeah.
All right. Well, Lauren, how do people get in touch with you?
So if you're interested, you can find me on LinkedIn for sure, Lauren Wells, or you can go to 7einvestments.com. I have my contact information on our website.
Where does that name come from?
And so it's a play on my co-founder's last name, which is Seven.
Oh, okay.
Yeah. A year later, I've had investors email me being like, oh my gosh, I just realized the 7E is
7 is his last name.
Yeah. Yeah, that's probably the best way to find me. Reach out. All my contact information is on the website. You can see a little bit more about what we do there.
Okay, well, thank you so much, Lauren, for your time today.
Yeah, thanks for
And
having me.
I think this is probably very eye-opening for a lot of people, or anybody newer to investing. So hopefully you've gotten something out of this, listeners. Thank you so much.